This is one reason why the Questwealth portfolios really stand out. They offer Canadians the best chance to maximize long-term returns within the...
Welcome to another installment of Robo Review. In this episode, we will focus on the portfolios from Questrade.
Hello everybody, welcome to the channel or welcome back. I am Justin, this is Tater Investing, where I am just into helping Canadians get closer to financial independence. Today's video is an updated and expanded version of the previous video I did on the Questwealth portfolios because they have made some changes. I will go over those changes as I walk you through the portfolio, and I will also dive into all of the individual ETFs held in these portfolios so you can understand what they all are and how they work. So when you sign up for a Questwealth account, you have to fill out a questionnaire, and based on your answers, they decide on the portfolio that they feel is right for you. They have 5 options ranging from conservative with 80% bonds to aggressive with 99% stocks. They also have small holdings and large holdings accounts depending on the amount of money you have to invest. The small holdings accounts have less ETFs, aka small holdings, but they are extremely well diversified. For example, the equity holdings in those accounts represent about 90% of the world's stock markets. I'm only going to cover the small holdings accounts in this video. Those accounts have up to 9 ETFs, so that's probably enough. But if you are interested in learning more about the larger holdings accounts and want me to do a video talking about the specific ETFs in those accounts, let me know in the comments and I will add it to the to-do list. But in short, the large holdings accounts just offer more ETFs, and Questrade has done this in an attempt to provide investors with more diversification and cost effectiveness. I personally feel that the small holdings accounts are more than adequate, but I'm going to try and leave my opinions out of this video and just stick with the facts. So here is a great one. For most investors, Questrade offers the lowest fees out of all of the robo-advisor offerings in Canada. So stick around because I'm going to discuss some of those other offerings later in the video and discuss why fees are probably the most important factor when you are choosing a robo-advisor portfolio. In addition to those fees I just mentioned, there are additional fees that come with any ETF or robo-advisor portfolio. They are called MER, or management expense ratio. I'm going to leave a link to the ETF video that I put out that explains ETFs and all the intricacies that you're probably going to want to know. If you haven't checked that out, make sure to. But the MERs in these Questwealth portfolios vary from 0.1% to 0.13%. Those are for the small holdings accounts at least. Okay, so some great topics for today. Obviously going to go through the Questwealth portfolios and the individual ETFs so you understand all of that. I'm going to cover costs, provide some data on why they are so important, why the Questwealth portfolios are such a great option, and then the X factor, why robo-advisor portfolios are such a great choice for so many Canadians. You are going to want to see all of this. So let's dive right in. We are currently looking at the Questwealth Balanced portfolio, which contains the identical ETFs that you will see in Questrade's more conservative and more aggressive portfolios. They just contain them in different proportions to produce a balanced portfolio that has, in this case, 60% equities and 40% fixed income. Now I'll start off with the fixed income, but I will just touch on it briefly and I will get to the equities very soon. The first ETF in the portfolio has ticker symbol CASH. This is a high interest savings ETF and pretty new to the portfolio. This is one of the changes they have made. It only takes up 0.5% of the portfolio, so I won't harp on it too long. The payout you could expect from this ETF is closely tied to the prevailing interest rate. These HISA ETFs primarily invest in high interest savings accounts offered by the Canadian banks, so the income they generate depends on the rates those banks are paying on deposits. And since they have $4.8 billion under management, they can negotiate higher rates from these banks than we individual investors could. Back to the portfolio, I'm going to skip over the second one just momentarily and focus on XBB, which is from iShares. It is their core Canadian Universe Bond Index ETF, a pretty standard bond ETF that you would find in many robo-advisor portfolios and certainly a solid holding. As you can see in the fact sheet here, it provides broad exposure to the Canadian investment grade bond market, so only very high quality bonds are found in this ETF. The vast majority are from our federal and provincial governments. Now, all of the ETFs I'm covering here, except for the cash ETF, have hundreds or sometimes thousands of individual holdings. So in the case of XBB, this one has over 1,700 individual bonds within the ETF. So you don't have to go out and look for other Canadian bonds or bond ETFs to diversify further. For the vast majority of Canadians, this ETF is really all you need for the fixed income portion of your portfolio.
Now, that being said, Questrade has diversified even further, a little bit at least, the fixed income portion of this portfolio. As you can see here, they have added XSB, which is essentially the short-term equivalent of XBB. Both have identical MERs at 0.1%. XSB contains Canadian investment-grade bonds with maturities ranging from 1 to 5 years. And like XBB, the vast majority are from our federal and provincial governments. Now, the third and final bond ETF on the list is quite different than the first two. The letters J and K refer to the fact that this is a junk bond ETF. Junk bonds are higher yield, but they are also lower quality, so this ETF would see significantly more volatility than the previous two on the list. I won't dwell on this one any further, as it only takes up 3.85% of the portfolio. XBB takes up 19.9%, and then XSB takes up 15.25% of the portfolio. Moving on to the equity holdings, ZCN is the first one. It's a Canadian equity ETF, the BMO S&P/TSX Capped Composite Index ETF. Definitely one of the leaders in this category. As we have a look at the fact sheet here, you can see super low MER, 0.06% is tough to beat, and the ETF tracks the S&P/TSX Capped Composite Index, which represents approximately 95% of the Canadian equity market.
So similar story to XBB, the bond ETF. When you hold ZCN, you are holding over 200 stocks in Canada, representing about 95% of the Canadian stock market. So just this one holding, this one ETF, means you are extremely well diversified in terms of your Canadian equity holdings. And it's a similar story for the other ETFs that I'm going to cover, the other equity ETFs, the US, the international, the emerging markets. They all have hundreds or thousands of individual holdings within those ETFs, so extremely well diversified. And like I mentioned around the beginning of the video, the equity portion of this portfolio is extremely well diversified overall. Owning one of these portfolios means you own about 90% of the world's stock market. Just wanted to mention, if you haven't subscribed yet to my channel, please do that so that you are notified when the next video comes out. Your future financial self will thank you.
Back to the portfolio, and the next ETF on the list is iShares Cohen and Steers Real Estate Investment Trust ETF. This is another change that Questwealth has made to their portfolios recently. They used to have a different real estate investment trust ETF that covered the global market. This one simply invests in real estate trusts in the US, and it doesn't take much of the portfolio at all, just 0.61%. So I won't dwell on that any further, and we will hop over to the next ETF on the list, which takes up the largest proportion of the portfolio, SPTM. This is the SPDR, or SPDR, S&P 1500 Composite Stock Market ETF. It tracks the performance of the S&P Composite 1500 Index, which represents approximately 90% of the investable U.S. equity market. Extremely low expense ratio of 0.03%. Part of the reason it's so low is because this ETF is in US dollars. Canadian dollar equivalents typically have significantly higher MERs. So if you're looking at purchasing one of these ETFs on your own, you don't want to pay the Forex fees. You want to execute Norbert's Gambit, so you can save on all of those currency conversion fees, and you can execute Norbert's Gambit within a self-directed account in Questrade. I will leave links to our Norbert's Gambit videos in the description, and you can see one at the top of the screen now. Next on the list is XEF. This is an international equity index ETF. It tracks the MSCI EAFE Investable Market Index, and it's a low cost and simple way, as you can see, to own over 1,500 stocks from Europe, Asia, and Australia. Now, these are considered developed markets, whereas there is another ETF in the portfolio at the bottom of the screen there that I will go through momentarily that covers emerging markets. Getting back to XEF, you can see to the right of the screen here, the management expense ratio 0.22% is significantly higher than what we have seen before, and this is primarily due to the fact that this is a Canadian dollar ETF. US dollar ETFs typically have lower MERs, like I mentioned earlier in the video, but in this case, we are better off paying a higher MER. In short, the reason is due to withholding taxes on dividends, which is probably beyond the scope of this video. But to explain really quickly, there are US dollar versions of this ETF available that would have lower MERs. However, if you held that US dollar ETF in your TFSA account, you would get an extra layer of withholding tax on the dividends that would come from the US government. No matter the currency of the ETF, there are withholding taxes from the various countries within the ETF, but we don't want to pay an extra layer of that to the US government. So we're better off in the long run paying a higher MER in this case. We do save on withholding taxes in RRSP accounts from the US government because of a tax treaty, but that is a subject for another video. I'm going to dive back into this ETF. So looking again at the XEF fact sheet here, you can get an idea of the geographic breakdown on page 2. And again, all of these countries are considered developed markets. Okay, back to the portfolio. The last ETF on the list is EMXC. This is iShares MSCI Emerging Markets ex-China ETF. Questrade added this ETF recently and replaced it with another emerging markets ETF that did include China. This ETF, EMXC, seeks to track the investment results of an index composed of large and mid-cap emerging markets equities, excluding, of course, China. As we look over to the right side of the fact sheet, you can see that this ETF provides exposure to 708 companies. Onto the second page, and you can see the top sectors. Pretty typical for emerging markets. They are information technology and financials. Over to the right, the expense ratio, 0.25%, also fairly typical for a Canadian dollar emerging market equity index ETF. In a few moments, I will discuss why costs are probably the most important factor when you are deciding on a robo-advisor portfolio. And I'm also going to mention one huge benefit of robo-advisor portfolio, so stick around for that. But first, a few more important points on the portfolios.
So let me quickly summarize all of the changes in these portfolios from the previous version of the Questwealth portfolios in earlier 2024. So they swapped out the emerging markets ETF. Like I mentioned, the previous one was SPEM, which did have significant holdings from China. The older portfolios used to call for 1.5% in uninvested cash. So they've reduced that to 0.49%. And then they've added in the cash ETF, the high interest savings ETF. And they have increased the allocation towards the short-term bond ETF. They've also swapped out the real estate investment trust. It used to be REET, which was an international real estate investment trust. The one that they have in the portfolio now that I covered earlier just focuses on US real estate. Note again that these were the small holdings accounts that I covered today. Questrade does offer large holdings accounts for larger investment portfolios. If you're interested in seeing some of those ETFs covered in another video, let me know in the comments. And I couldn't find any explanation as to why Questrade made the changes that they did that I just went over, but they're really not all that significant anyway. The core holdings are very much the same, as is the whole concept of the portfolio itself.
Just wanted to really quickly go over the other portfolios that Questwealth offers. We looked at the balanced portfolio in this video, and just closing off on that one, we looked at the allocations towards the fixed income portion of the portfolio, but in terms of the equities, you can see that the Canadian ETF takes up just about 10% of the portfolio. We'll skip over the REIT, that's fairly insignificant. The US equity index ETF takes up just over 30%. The international ETF over 17%, and then the emerging markets ETF 2.34%. Hopping over to the Questrade website, and we will have a look at the growth portfolio. This one's a little bit more aggressive, higher allocation towards equities. As we scroll down, you can see here 80% stocks, 20% fixed income. The portfolio maintains a consistent allocation within each asset class, meaning that the ratios between the individual ETFs remain the same regardless of the portfolio's risk level. So as the portfolio moves from conservative to aggressive, the proportion of equities increases, increases relative to fixed income, but the distribution among the equity ETFs stays unchanged, or relatively unchanged anyway. So the best way to look at this, or at least a good way, is to have a look at the aggressive growth portfolio, which is 99% equities. If we scroll down a little bit, we will see the breakdown of Canadian versus US versus international. So no matter what Questwealth portfolio you choose, the equity portion of it will have a similar breakdown to what you can see on the screen here. So you will have just over 16% Canadian equities, just over 50% US, and just about 1/3 international, which would include the developed and emerging markets ETFs that we looked at. Okay, so we've looked at the balanced growth and aggressive growth portfolios. Really quickly, the income has 40% equities, and then the conservative income portfolio, 20% equities and 80% fixed income. So as I mentioned earlier, for the majority of Canadian investors, Questwealth offers the lowest fees among all of the other robo-advisor offerings in Canada. There is another one, Nest Wealth, which offers a monthly fee structure, but you would have to have a very large portfolio in order to see a benefit. The specific management fees charged by Questwealth are based on portfolio size. So up to $100,000, the fees are 0.25% per year. And then once you hit and exceed $100,000, the fees drop to 0.2%. Let me quote the legendary John Bogle, founder of Vanguard and pioneer of the low-cost investing methods that we all enjoy today. Performance comes and goes, but costs roll on forever. The more managers and brokers take, the less investors make. This principle forms the very foundation of smart, long-term investing, and is one of the key reasons why low-cost investing options like those from the Questwealth portfolios are such a great choice for Canadian investors. There is no shortage of research proving the negative impact of high fees on portfolio performance. A 2020 study by the European Securities and Markets Authority showed that retail investors, regular people like you and me, pay significantly higher fees than institutional investors, like the big banks on Wall Street, and this directly leads to lower returns over time. Morningstar research consistently shows that costs are the single best predictor of portfolio performance. This is one reason why the Questwealth portfolios really stand out. They offer Canadians the best chance to maximize long-term returns within the robo-advisor category thanks to their cost advantage. Okay, so I think I've covered the effect of costs and fees on portfolio performance. Let's talk about another factor that can be even more impactful: your own behavior. Because even if you're in a low-cost portfolio, your decisions can make or break your investment success. One of the most well-known organizations studying investor behavior is Dalbar, a leading financial research firm that has been analyzing how investors perform relative to the market for decades. Their annual reports consistently reveal a troubling pattern. The average investor underperforms the market, not because of poor investment decisions, but because of emotional decision-making. Behaviors like panic selling during a downturn or chasing hot stocks at their peak are some of the most common mistakes that can significantly hurt investor returns. This is where the Questwealth portfolios and robo-advisor portfolios in general provide a really big advantage for investors. Your portfolio is professionally managed and rebalanced automatically. This eliminates the potential or temptation for investors to make bad decisions that could derail their portfolio's performance. When your funds are locked into a Questwealth portfolio, you're protected from one of the biggest threats to your investments, yourself. The system ensures your portfolio stays balanced, aligned with your goals, and optimized for long-term growth, no matter what's happening in the market. So whether it's the low fees or behavior-proof design, the Questwealth portfolios provide two of the most important ingredients for investor success. By providing low costs and eliminating the chance of your behavior having a negative impact on your portfolio, they let you focus on what truly matters, which is growing your wealth over time. Now, I mentioned earlier in this video that I'm going to try and eliminate my opinion as much as possible. In the previous review I did of the Questwealth portfolios, I did mention that I wouldn't personally invest in them because of the lower allocation towards Canadian equities when compared to the US and international equities. So while I personally have about 1/3 Canadian equities, 1/3 US, and 1/3 international, not all investors choose to have these allocations. So I'm going to leave my opinion out of it
Many of the other robo-advisor offerings have a higher allocation towards US and international equities when compared to the Canadian equity allocations. The US is a larger market as it has provided higher returns over the long run. So that's what a lot of investors are interested in. Just be aware that when you have a higher allocation towards the US and the international markets, that you are going to see more portfolio volatility, or at least you probably will. And that is due to the currency fluctuations, the Canadian dollar versus the US and versus the other foreign currencies. But when Questwealth chooses a portfolio for you, they are almost certainly taking this into account. So they are going to most likely provide a portfolio that is going to suit your individual risk tolerance. Again, I'm going to try and leave my opinion out of these videos. And frankly, when it comes to most finfluencers out there, their opinion is generally all that they provide. What you want to seek are sources that reference trustworthy studies that are peer-reviewed for rigorous evaluation, transparent in their methods, data, and conflicts of interest, findings that are replicable and verifiable, conducted independently of financial incentives, and based on robust long-term data trends. This is the best information that investors can find, certainly better than listening to someone's opinion, even if they are an expert. Think about it. We have an incredible wealth of data on how markets behave over time, stretch back to the very origins of our financial systems. We have a means to analyze this data to form meaningful information to help us direct our investments. So why would we just listen to one person's opinion anyway? Now, before you do anything else, make sure you subscribe so you don't miss out on the next video that comes out. If you like this one, a thumbs up would be great. If you know anyone who could benefit from videos like this, then please share. I bet they would appreciate it. I know I would. So, thank you for watching, and we'll see you again soon.